So good afternoon, everybody. Thank you for joining us for another Hamilton Wealth Partners Fund Manager webinar. My name's Kane Barano and I'm a partner at Hamilton Wealth. So the format for today's webinar will be the same as previous webinars. So I'll commence by reading a brief advice warning. I'll then introduce our guest speakers and hand over for about 20 to 30 minutes for presentation. We'll open up for questions at the end, but do feel free to submit any in the Zoom taskbar below throughout the webinar. So the information contained in this webinar has been provided as general advice only. The contents have been prepared without taking account of your objectives, financial situation, or needs. You should, before you make any decisions regarding any information, strategies, or products mentioned in this webinar, consult your advisor to consider whether that is appropriate, having regard to your objectives, financial situation, and needs. So today I'll be joined by Sivapalan and Liz Harrison from Janus Henderson Investors. Now, Jay is a portfolio manager and head of Australian fixed interest at Janus Henderson, where his responsibilities include formulating interest rate and sector strategies. Jay joined Janus Henderson in 2015 as part of the acquisition of Perennial Fixed Interest, where he was most recently a partner and senior portfolio manager. Liz is a fixed interest analyst specialising in ESG at Janus Henderson. Prior to joining Janus Henderson, Liz was a fixed income product specialist at Escala Partners in Melbourne. Before that, she worked in business development for a startup company. So with those introductions, I'd now like to hand over to Jay and Liz to introduce Janus Henderson and touch on their fixed income strategies. So over to you, Jay and Liz.
Thanks, Kane, and good afternoon, everybody. Certainly our pleasure to be speaking with you today about all things markets. So what I'd like to do over the next 20 or 30 minutes is really go through what we're seeing on the ground in terms of markets. Now, of course, we are involved in fixed interest as an asset class or bond markets, but certainly we look at investing through the lens of the economy and across a range of asset classes, including growth assets like shares, property, infrastructure, and then of course, defensive assets like fixed interest and cash. So what I intend to do today is really introduce us and then talk a little bit about the early stage economic recovery that we're seeing. Now that has a few very good positive implications for investors, but also some implications for defensive investors, namely rising rates and a rising rate environment. So from a fixed interest investor's perspective, that's an environment that we need to navigate to preserve capital first, and then really focus on those opportunity sets that we have as active managers to enhance returns for you all. And then I'll invite Liz to talk about what we're doing in terms of doing good with your capital. So that's all the way from environmental, social governance factors to positive impact investing and some of the work that we're doing there. And then I'll finish off with talking about the higher levels of income and yield and return potentials that we're starting to see in even sleepy and defensive asset classes like fixed interest. But very much looking forward to your questions towards the end of this session, which I think is really the crux of today's session. So just very quickly, Janus Henderson is a global asset management firm. And as you should expect from any large global asset management firm, it's well represented across various geographies in North America, Europe, and of course, broader Asia Pacific, including Australia, managing investments across all the major asset classes of share markets, fixed interest, alternatives, and so on. And you can see they're represented by 2,000 employees, managing a total of just over $500 billion in assets. For our part, as Kane introduced us, we've been as a core together and managing money together for just about 20 years. For my part, I've been with the organisation on a continuous basis for 20 years, albeit as part of Janus Henderson for the last 6 years. And you can see on the right-hand side the different types of assets that we manage on behalf of clients. We manage about $15 billion with my team, a team of 8, including Liz, and we're all based in Melbourne, just very close to, or not too far away from where Hamilton Wealth is located. And what we've really sought to do is be a specialist debt manager. So what that means is really cover the full spectrum of fixed interest solutions and be an active manager. So not a passive manager, but an active one. And we'll go through some of the things that we do as an active manager shortly. The fund that's used by Hamilton Wealth, and in particular, many of you as investors would have exposure to this as part of your defensive allocations. It's called the Tactical Income Fund. And so I might refer to this through the discussion today. So what is the fund? It's a defensive investment solution for investors with an absolute return mindset. What does that actually mean in practice? It means that we're trying to avoid the big drawdowns that occur every now and then in bond markets and try to deliver a more smoother return profile for investors with a focus on capital preservation. How do we do this? It's through active asset allocation. So you can see the different boxes there. So the Tactical Income Fund in the charcoal box, it just invests into these 3 other underlying funds that we also manage. Australian Fixed Interest, so let me give you an example of an asset there. A 10-year government bond, which is fixed rate. Conservative Fixed Interest, think of that as a 5-year Australian bank like NAB, the floating rate assets. Of course, cash in the red there, and then higher yielding securities like hybrids in the green. So that's what we do. Now, let's get on with the discussion of where we are in the economic cycle and what that means for investors. We are in the early stages of an economic recovery, but this is an economic recovery like no other. And that's because we faced a pandemic and a downturn like no other last year, and a government and central bank response, a support response like no other that we've seen in our lifetimes. And so we're going to go through this period of a very strong economic rebound and recovery. Now, for a lot of the world, in particular the developed countries like the US, UK, and broader Europe, that actually started occurring in 2021, this year. For us, we had a false start, and in particular, us in Victoria, we had a false start and went back into the lockdowns with Delta. So you can see here, a lot of our growth is forthcoming next year. It hasn't been lost, but it's coming. Next year, we have economic growth in the green, running at about 5.25%, with the biggest driver of that consumption. So that's all of us, heading back to the shops, the cafes, the various things that we all enjoy doing when we're out and about, and that's that consumption story. Business investment and public sector are also poised to be pretty good contributions. But you can see here housing, and when we talk about housing, we talk about housing construction, is much more modest, in fact, largely flat. And that's because we do have some macro-prudential rules that APRA, the banking regulator, has implemented. And so we do see some tapering off the housing sector moving forward next year. Now, of course, markets are always looking ahead. It's one thing to talk about economies, but markets are already looking at what the other side of the economic recovery looks like. Now, of course, when you're in the early stages of an economic recovery, what should we always expect? We should expect that companies are doing well, consumers are doing well, employment is good, and wages are starting to rise. And that should be reflected in particular risk assets or growth assets like share markets, property, and we've seen that. Even after the second half of last year being a bumpy year for share markets, we've had, again, somewhere between 15 and 25% returns in share markets this year. But this environment is also an environment where hopefully you can see the little written bullet points here. Growth expectations also create a shift in market pricing and shift in expectations. So investors start thinking about, well, where to from here in terms of the RBA cash rate? Do they need to tighten policy and normalise policy? What about inflation? Does inflation start building as the economic recovery unfolds? And are we about to embark on a global cash rate tightening cycle? And so the markets start pricing that in. Now, in the green line here, you can see the actual cash rate hasn't moved yet, and that's why returns are still stuck at pretty close to zero. And many of you, to the extent that you have other investments like term deposits, you would have noticed and still be rolling into very low yields in term deposits. Now, as the markets start pricing in the future path of cash rates rising, traditional bond products, they have an inverse relationship to bond yields. So in other words, when bond yields or interest rates rise, bond prices fall. And you can see that in the orange line here, and that's Australian fixed interest, delivering a negative circa 3.8% for this calendar year. Over the last 1 year, fixed interest has delivered a negative 5.3% return. Now, that's not such a bad thing, and that is perfectly expected through this market environment. Why? Because defensives are there to perform really well when share markets are falling. When we had COVID-19 in March last year, fixed interest performed really well when share markets were down 30-odd%. And we saw that in the GFC, we saw that in the tech bubble and previous crises prior to that. Now, this year, you're really getting the good returns from the growth assets like shares, whilst the orange line is moderating. Now, for our part, what we're really trying to do is navigate this so we avoid the negative returns coming out of fixed interest to preserve capital, and then we look for better returns moving forward. So why is this happening? Just in a nutshell, there are a range of coloured lines here, but if I can just focus on the red line here on the right-hand side, effectively the Reserve Bank is maintaining the idea that it's going to keep cash rates at pretty close to zero for the next at least couple of years. Whereas the red line is what the market is expecting in relation to cash rates moving forward. So there's a gap, there's a disconnect between what the markets think is going to happen and what the RBA says is going to occur. And one of them is going to be right. And markets have a habit of, making these views priced into the actual securities. So for us, this gap is an opportunity and an opportunity to exploit. But as a result of this pricing, you can see here that 3-year in the black and 10-year bond yields have also risen. And that's basically just indicating that the markets always try to front run what the RBA might actually do, and in many ways often fully price in what the RBA might do, and then once the RBA actually starts raising rates, the market actually doesn't go anywhere. It's already fully priced that in. Just for reference, our base case view about the RBA cash rate is that we're still on hold for the best part of the next couple of years, probably about 18 months, and then a gradual tightening cycle that gets the cash rate up to about 1.75%, what we would consider our neutral rate. Now you can see the markets always jump ahead. So back in August, the market was really in the orange colour, only assuming a 1% cash rate by the end of this decade. And then now in November, in the blue, pricing in a more aggressive tightening cycle. Now, coming back to the RBA, they've been quite explicit. What do they need to see before they start tightening policy? It's this conditions, the trifecta conditions. The unemployment rate close to 4%. We'll probably get there next year. Actual inflation sustainably about 2.5%. Again, we might get there late next year. Wages growth above 3%. That's going to be a little bit harder to achieve. And you can see here a number of lines, but are various measures of wages or inflation in the black, blue, and red. Enterprise bargaining agreements in black, average compensation per employee in blue, and then in the red, wages price index. And then the unemployment rate in the orange. So you can see we've got a ways to go before we really stoke wage inflation, albeit there are some bottlenecks right here, right now, as we reopen our economy. So that's sort of the backdrop of, the economy and the necessary the necessary transition we need to make from ultra easy 0% cash rates to something a bit more normal. So how do we navigate these markets? Well, I showed you earlier in terms of what's been happening in the bond market. This is the price return of the different buckets, if you like, or the different choices that bond investors have in the context of Australian fixed interest. And you can see the vast majority of these have been negative, with the exception of floating rate. So we've been focusing a lot more in terms of our strategies on the right-hand side and avoiding what's been occurring on the left-hand side. And that's really important. Now, how do we do this? Well, it's through asset allocation. Again, if you recall back to when I first started speaking, I spoke about the 4 coloured boxes and the different exposures we can have. Well, this is just the asset allocation to those 4 different boxes. In the charcoal is that fixed interest exposure that's been negatively returning, and you can see our allocation got down pretty close to 0, so we weren't exposed to that. In the red is the, I guess, safer for this environment, floating rate investments, so not exposed to rising interest rates. That's where we've had the bulk of the portfolio, higher yielding assets in the blue, and then cash and synthetic cash in the orange there. Another way of saying the same thing is what we call interest rate duration. Now, I'm not necessarily looking here to go through the details of what that is, but rather just say that when this orange line is close to 0 towards the bottom of this panel, it basically means that the fund is not exposed and not impacted by rising rates. And then when these orange lines are higher towards 2 years, it is exposed to rising or falling interest rates. So in short, if we expect interest rates and bond yields to rise, we want to have very low duration like we had 2 or 3 or 4 weeks ago. And once a market is factored in and already priced in a rising rate environment, we want to really dial that up. And the reason is sometimes the markets get it wrong and then they settle back down, and that provides some capital gain opportunities. What is the end outcome of this type of process? Firstly, on the left-hand side, over the last 12 years, whilst this fund has been running, the broader bond market has delivered 42 negative monthly returns, whereas this fund has delivered 8 negative monthly returns, so materially less. And more importantly, the cumulative return, even with these down markets, has been positive 9% net of fees, versus the bond market that's been negative 22%. So it is really important to navigate this rising rate environment by actively managing that interest rate risk, or what we call duration risk. And you can see that here. So this is just a chart of $100 invested over time. The blue line is what we call our benchmark or our index. Of course, you would expect us to outperform that. The fund is the orange line, so comfortably outperforming the blue line. But the red line here is a broader bond market. And you can see over the last 12 years, it's basically had the same performance as the fund, but much more choppy and much more volatile than the broader fund. So I've spoken a lot about navigating this interest rate environment that we're in and this normalizing interest rates. Let me now flip that on its head because everything what I've spoken about so far is about preserving capital, but flipping on its head to where can we enjoy and get better returns for investors. There are a range of things that we can do as active managers. Firstly, in order to capture higher returns, I've already spoken about when bond markets have baked in a higher rate structure, we can lock that in for investors. In particular, when the markets have got a bit carried away and priced in too much good news, that's good for investors. Let's go and lock that in. So that's step number one. The second area is all around what we call spread products. So what that means is lending money to our states versus the federal government, and lending money to companies and what we call asset-backed securities, so residential, mortgage, housing, loans, and so forth. So on that second point, what we have at the moment is a relatively highly convicted reopening of the economy theme. What we saw 3 months ago is when the states, in particular New South Wales and Victoria, were on their knees with heavy lockdowns, we saw that New South Wales government bonds, which are relatively low risk bonds, they were paying a good best part of 0.5% more than federal government bonds. Now, if you buy a 10-year asset, you get to enjoy an additional 0.5% for all of the next 10 years. Or if that spread normalizes, then you get a 5% total return, additional return as a result of those bonds. So we invested in those. The second area that we've been investing is lending money to companies, what we call credit. Now, this is not broad brush credit like we did last year. So last year was, coming out of a pandemic. It's a bit like the share market. You could invest just in the broad share market and you would have done well. You didn't necessarily need to go and pick Macquarie Bank or Woolworths or individual companies. This year, you've got to be a lot more selective. So we've identified 3 themes. First theme, it's all about getting out and about, all of us moving around again. Who should that benefit? It should benefit the retail sector, the office sector once we start working from the office again, and the consumer sector. Theme 2, opening up our borders. Who should that benefit? It's our universities, our airports, and our housing construction sector. And then theme 3, in an economic recovery, in particular with our major banks who are moving away from this almost free money that they were achieving last year from what we call the term funding facility from the Reserve Bank, to now having to borrow money on their own right. Their cost of funds is starting to go up. Senior debt, which is pushing up spreads on subordinated debt. And we think that the capital levels, i.e. bank hybrids or capital notes, are well placed again. So these are 3 things that we've been running through the portfolio. You can see here where the opportunities are. I'll just focus on the left-hand side here. So you can see because of what markets are baked in, we can buy a 5-year government bond and you can see the type of total return that we expect. Even though the yield is only 1.12%, these other components allow investors to try to achieve a return closer to about 3.8%. In a similar vein, we are in a recovering economy, so it's important to have some inflation protection. The blue line here, you can see, is what the market is pricing in for the average rate of inflation over the next decade, and that's just tipped into the RBA target band of 2 to 3%. Now, of course, this can shoot to the upper side. We think it'll probably settle somewhere between 2.5% and 2.75%. So it's worthwhile on the bottom panel here having some inflation protection, which is what we have in our portfolios on behalf of investors. State government bonds, I already spoke about that. Really, on the bottom panel here on the right-hand side, near label number 6, you can see we've dialed up our state government bond exposure. And this is pretty much to New South Wales and a little bit to Victoria. And that should play out as we open up and come out on the other side. And then lastly, if I just look at where the value is for investors, we break up the industries and the type of companies into these three buckets. On the left-hand side, what we call sleep easy at night, you don't have to worry, recession or not, these are all industries and companies that are going to do really well. In the middle, challenged but okay, they were good companies or entities that were hard hit by the pandemic. And then on the right-hand side, structurally challenged, but we don't want to have any exposure. Last year, we had 95% of the portfolio in the blue and 5% in the orange. Today, we have about 75% in the blue and about 25% of the orange. Why? Because these are the areas that are going to perform well in our assessment as we move forward. The university debt, the lowly geared property trusts, the airports, and the other core infrastructure assets. And you can see that we've taken quite large positions in these areas. Again, don't worry too much about the notation, but rather the colours of the bars. So label number 3 here, the REIT sector or the property trust sector, you can see we've dialed up that exposure. Label number 4, the university, we've dialed up that exposure. And then the airports, toll roads, we've dialed that up. And we've dialed down major bank senior debt. So with that, I might just pause for a little bit and then pass on to my colleague Liz, who'll talk a little bit about what we're doing with your capital.
Good afternoon, everyone. A very important part of our investment process here at Janus Henderson involves company engagement. So as part of our approval process for investments, we undertake ESG-aligned questions in nearly every meeting we have with an issuer to varying degrees. This could be when a business presents their results or about to launch a new bond deal. It could be when there is an emerging ESG issue that causes us to review our investment limit for that company. It is also often at our request when we want to be updated on a company's response to an emerging ESG theme, such as modern slavery risks, climate-related issues, COVID impacts, etc. We spend a lot of time getting on the front foot and engaging with companies and asking them lots of questions. There are many issuers that we haven't approved onto our investment approval list due to ESG concerns. There are obvious ones that are screened out because of the industry they operate in. These include those in tobacco manufacturing, adult entertainment, and controversial weapons. But there have also been others such as Ale Property Group, Crown, and Tabcorp with concentrated exposure to alcohol and/or gambling, Thames Water, which is heavily affected by climate change, and infrastructure assets such as rail and coal port terminals that are reliant on fossil fuels. The reason companies are not approved during our ESG process is because we felt they had material ESG risks that could affect the company's credit profile. But does this flow through to the performance of their bonds? AMP is an example of an issuer that was suspended on our approval list due to poor governance. While AMP is a long-time, strong company that has a bright future ahead, it has a journey to go through. If we go all the way back to the Royal Commission, we saw the revelations regarding falsifying documents and charging fees for no service as a fundamental flaw in their governance and culture. In May 2018, we formed the view that this behaviour would change the financial profile of the company via a loss of clients and a loss of assets under management, thus leading to a fall in revenue and profitability. At that time, we decided to suspend AMP on our approved list. This meant we couldn't buy any AMP bonds in our portfolios. Since suspending them, we have followed the performance of some of their bonds. On this chart, we depict a comparison between the performance of an AMP and Suncorp bond. In late 2018, they both issued subordinated debt. Both were rated the same at BBB+. At the time of issuance, AMP was suspended, which meant our process wouldn't allow us to buy the bond regardless of price. In contrast, Suncorp was an approved company on our list. Here in orange is the price performance for AMP. The bond was issued at a credit spread of 275 basis points. What that means is that an investor gets an additional 2.75% for lending money to AMP as compared to risk-free government bonds. Here in blue is Suncorp's, issued at 215 basis points. And you can see the difference in bond price performance of the two. So AMP's bond was issued 60 basis points higher. In other words, you received an additional 0.6% in interest payments by owning the AMP bond over the Suncorp bond. But what has been the total return over time when we also consider capital moves? Since it was issued, the price on AMP has fallen, given their challenges and multiple credit rating downgrades. It has returned 8.7% in 3 years. In contrast, Suncorp, which was offering a lower margin at inception, delivered a better return of 10.7% as the bond price went up. While the difference in return is only 2% in 3 years, in this low rate environment, it does show that ESG considerations can make a difference. Next slide, please, Jay. As mentioned earlier, we also engage with companies on broader ESG issues that we see emerging and talk to them about their approach. A recent example are discussions we had with several retailers on modern slavery risks in their supply chain. In addition to being across the finer detail of issuers' modern slavery statements, we believe direct company engagement is critical to gaining a better understanding of a company's process for identifying and managing modern slavery risks. It is worth noting that while each company views modern slavery slightly differently, there is still a lot of commonality in their approaches. Breaches of working conditions are still very present, but the additional oversight and proactive management on this issue over the last few years can only be reviewed as a positive step. Climate risk is far-reaching and goes beyond the large polluters. Many of our engagement meetings talk about climate and specifically how an issuer is addressing this risk within their business. A plastic packaging company might not be an obvious choice when we think of a company with strong ESG credentials. However, Amcor is ranked highly by ESG-focused rating agencies such as MSCI and Sustainalytics. The company is also included in major ESG indices. Upon engagement with Amcor, they told us that they believe that the plastic pollution problem can be minimised and progressively even eliminated by innovative product design, advances in material science incorporating bio-based raw materials, the development of advanced recycling stream infrastructure in partnership with government and industry, and through incentivising and influencing end customer waste disposal behaviour. Just in the last month, we have met with other issuers to discuss the effect of climate change on their business. These include the Suncorp insurance business, given they are on the front line in terms of the volatility of natural hazards linked to climate, Coles to go through how they plan to meet their objective of being fully renewable by 2025, Dexus on creating a greener building sector, and the Queensland and Vic state governments on their sustainability pool of assets, the majority of which are climate-related projects aimed at achieving their 2030 carbon reduction targets. While a global pandemic was never identified as a social risk prior to 2020, it has caused major disruptions in businesses and the supply chain that they are a part of. Recently, we caught up with the automotive company VW to understand more about the shortage of semiconductors and the ongoing issue this is causing them. Understanding their hurdles assists us in evaluating the materiality of this social risk on the issuer. And finally, we also engage with issuers as they look to issue sustainable bonds. There has been a marked acceleration in the first half of 2021 in sustainable bond issuance. By the end of September this year, the global market is said to be up 100% from the same period in 2020. While Australia has a lot of catching up to do, there has been a notable increase here as well. As allocators of capital, we seek to have as many conversations with issuers and intermediaries as possible in an attempt to help develop this market further in Australia. Like the AMP and Suncorp example earlier, we have seen a really positive development in the Australian green and social labelled bond market. One of our analysts compared the performance of a portfolio of labelled bonds compared to their non-labelled equivalent. Comparison bonds were found, where possible, with similar ratings and maturity profiles. In 83% of cases, the labelled bond has outperformed this calendar year to date. If this trend continues, then there is a strong return argument for us to invest in these green and social bonds, as well as the contribution we are making to a more sustainable global economy. We buy labelled bonds across all of our portfolios. We currently own in excess of 850 million labelled bonds, and in some cases, they make up to 10% of the fund. This is in addition to other investments we have, which we classify as best-in-class ESG. We write up many of our engagement meetings and publish them to clients on a quarterly basis. This publication also showcases the positive impact investments that we hold and reports on carbon intensity and ESG ratings of our public offered Australian fixed income fund. Thanks for listening. I'll now hand back to Jay.
Great. Well, thank you very much, Liz. I might, sorry, Jay, did you have more to go, did you?
Oh, no, that's okay. Look, I was just going to finish with 10 seconds of, what is the environment we are in? capital preservation is really key to navigating the environment that we're in. But base and raw cash rates and interest rates are lifting, so there are better returns ahead for investors in defensive asset classes. But certainly there are ample opportunities to enhance returns through the type of work that we do. And hopefully today we'll be able to showcase some of that. But it is important for all of us to take calculated but bold risks to enhance returns moving forward.
Great. Well, thank you both very much. I might start with a question, just a broad one. Are the bond markets right, or are the central bankers right when it comes to the path for interest rates?
Yeah, so look, I think there's two aspects to this. So as far as central banks go, I mean, they were very right in employing ultra easy monetary policy last year. That's what they really needed to do. And they also needed to provide certainty that it was going to stay low for a considerable period of time to get the confidence for investors to come back into the market, for companies to expand, for individuals to, make their purchasing decisions and so on. So it was the right decision for that time. But we are moving on now, and we are on the other side of the pandemic, hopefully, uninterrupted, but we also are very aware that we might have some interruptions and hiccups along the way. But nevertheless, we need to go back to normalising. And I think what we'll see from the central banks is some sort of normalisation where they perhaps will look like they're not sticking to their original commitments of keeping the cash rate low. Equally, on the flip side, the bond markets have just gone too far and taken it too far. So right here, right now, we think that the bond market is probably wrong compared to the central banks.
Okay. Maybe just following that point on normalisation, you mentioned in your presentation, you see the neutral cash rate domestically at 1.75%. Pre-COVID, the cash rate was 0.75. There's been a lot of debt raised at very low levels, increasing the sensitivity of interest rate rises to the economy. Where do you see this so-called neutral rate, and do you think it is more sensitive these days?
Yeah, certainly the cash rate and future cash rates are going to be much more sensitive for the Australian economy, just as a result of higher levels of household debt. And when we look at a neutral long-term cash rate of 1.75%, we're looking at that in combination with a range of other factors. So a 1.75% cash rate is probably a mortgage rate of very high threes, so just under 4% if you like. But that is against a backdrop which I didn't get a chance to discuss today, of quite a different fiscal policy mix. So if you looked at the last decade, and in particular between the GFC and COVID-19, the government was effectively pulling back support right through, trying to get the budget back to surplus. So we had monetary policy being easy and going one way, and fiscal policy going in the opposite direction. Looking forward, we're going to actually have the two going in the same direction, and therefore monetary policy doesn't have to work as hard. However, the winners and losers are going to be quite different to pre-COVID-19. And I think we're already starting to see that. Additional spending in defence, additional spending in national security, some local manufacturing of healthcare products and services and so forth, and the digitisation of the economy and renewable energy.
Thank you. Another one for me, this may be more for you, Liz, but also you, Jay, just on the green bond side. Most people talk about the ESG side of investing in green bonds, but we're seeing, just the demand for these is creating good alpha opportunities. Are you able to touch on what you're seeing out there in the market?
Yeah, sure. I might take that one, but Liz, I think it's worthwhile maybe touching on the work that Artie's been doing on this as well. But just at a high level, Kane, and for the audience, what we're seeing is very strong demand as investors become much more demanding, rightly so, of their investor capital above and beyond just purely return and risk and liquidity. They want their capital to also have a positive impact and do good, which is very appropriate. And so we're seeing a lot of money I guess, pursue the same assets, and perhaps the issuance of this not be as quickly as forthcoming as we would like. And so therefore we're seeing some outperformance of those assets. And that will, likely continue for some time. Liz, maybe if you just touch on the work that Artie did, specifically in relation to green bonds.
Yeah, so that's what I was mentioning in my section there. So one of our analysts put together, all of the green labelled bonds that are out there in the Australian market, and then did a comparison against non-labelled bonds, just to try and ascertain what the performance has been over the last year or 2 years. So since the life of the bond, 75% of the time, the green bond outperformed its non-labelled equivalent. And then just this calendar year, 83% of the time, those green bonds have outperformed. So definitely a very strong argument to continue to investing. And as Jay mentioned, we hear a lot about the greenium that exists in offshore markets. We haven't seen that as much here just yet. There is still not enough supply here yet, and a lot of demand. So those dynamics may change, but at the moment, as we're still building out our supply, we certainly haven't seen that greenium that is very obvious. It's somewhere between 5 and 15 basis points in offshore markets.
I think it's a great point for those that aren't fully on board with green bonds. It's that alpha piece is definitely there, and they are outperforming, which is good. Just another question. The last few months, we've seen one of the biggest sell-offs in bond markets since I think the early to mid 90s. What led to your zero duration positioning heading into this sell-off? What did you see that obviously the market is?
Yeah, so I think, look, our top-down view, really starts with where are we in the economic cycle? We are in the early stages of the recovery. What should we expect as we go through the recovery? We should expect whatever normal looks like, a normalization of cash rates. And so markets rightly try to discount that, in other words, price that in and bring it forward. And so that's what we were expecting. Now, against that, we look at what has markets already priced in. So when you looked at August, for example, the markets had the RBA really not doing much and only getting a bit above a 1.25% type cash rate, even in 5 years' time. So we felt that it was pretty safe, a safe bet, if you like, to really look to preserve capital, because the market didn't price in much and it was prone to being able to price in more very quickly, which is what ended up happening. And therefore we ran zero duration or no interest rate sensitivity in the portfolio. Okay,
thank you. One last one from me. We hear a lot about inflation within the global context. However, I feel like there's a lack of understanding towards the different dynamics that drive inflation at a country level. Are you able to maybe touch on some of these and, at a different country level?
Yeah, sure. Certainly can do that. So I guess inflation globally, I think our feeling has been that it is likely to be transient or transitory rather. But that said, that transitory in our mind could take 2 to 3 years. So it's what we call sticky inflation. So it's not like it's there forever, but it is likely to have a hump, and a pretty big hump, and then be quite sticky there for some time before it starts receding. Why? Because last year, the pandemic really upset supply chains. Now, all the supply chains we all know about and we've all read about. But you have to add to that 2 other big things that we feel are occurring. Firstly, that very natural, long-established free trade agreement between the East and the West has now been upset, and now we've got to reform trade arrangements with other countries. So that's another, new factor. And then the third factor is that the whole globe will have to transition to a net zero world. So there's an enormous amount of change that companies have to look at. Just a bit earlier on, Liz and I and one of our other colleagues were talking about, Coles and the amount of money that Coles is spending on all things from renewables to the circular economy and reducing waste and so on, which 5 years ago they wouldn't have spent. So, all of this is disruptive, and that's going to lead to inflation. That said, as discussed, it's likely to settle back down, but perhaps not to the pre-COVID levels, but a level perhaps a little bit higher than pre-COVID levels. Bringing it back to countries, that's most evident in the US and, of course, in the UK and Europe. And Australia is quite a way behind. Now, we've got some inflation coming through in terms of goods and services, but not in terms of wages. So what's been quite perplexing for us is the US and Australia had the same cash rate profile, in other words, the future path of cash rates, yet very different wages inflation outcomes. And I think that's really important when we're thinking about Australia and wages.
Well, thank you very much. So yeah, thank you, Jay and Liz, for your time today. Everybody listening at home, thank you for joining us. I hope you've all gained some valuable insights and enjoyed hearing about Janus Henderson and their fixed income capabilities. If you've got any more questions, make sure you send them through and we'll answer these after the webinar. So yeah, I'd like to thank you again, Jay and Liz, and I hope you enjoy the rest of your day.
Thank you, Kane, and thank you to all the investors listening in for the opportunity to present today. Have a good day.
Thank you. Goodbye.
Great, thanks. Bye.